Thank you, and welcome everybody to our 21st annual Colliers Outlook Conference. We appreciate having everybody here. I do want to start off, thanking each of you, but also acknowledging and thanking our sponsors. Without them, we can't put this event on. And so our presenting sponsors, seated at the tables up front here, Givens Pursley, thank you very much. Washington Trust Bank, Land Pro Data, and ServPro. Round of applause for the presenting sponsors. And then we also have a number of co-sponsors that we'd like to recognize and thank. A10 Capital, Bus Mechanical Services, Centimark Roofing, Cutting Edge Landscape, Biome, Rocky Mountain Electric, and TradeStar Construction. Thank you, all of you. And then one final sponsor acknowledgement every year. A good friend Jeff Heath and the team at Freeform provide us they decorate the stage and provide us the furniture for your business furniture needs. Please talk to Freeform. Thank you guys. So a couple of just I guess more housekeeping items. First of all, we will try to entertain as many questions from the audience as we can. We've got some great speakers and a panel, and we will have some time for questions, but we find the easiest is we do have a number that you can text a question to, and that will end up on iPad up here, so I'm able to work those questions in or ask them directly at the end. We will reserve questions till the end, so the speakers each will speak, and then the panel, and then we'll have time for questions. But if you can, it's on your program, but also the number is 208-941-7902. Again, 208-941-7902. So please feel free to text questions in at any time during the event, and we'll be able to take a look at them and answer as many as we can. Now, a civic duty. We are, I don't know if anybody's aware, we're 6 days away from an election. You might have heard a little bit, and all I would say is I'm going to encourage everybody to get out and vote. And that's the last political comment you will hear today. We are commercial real estate folks. We're not political prognosticators. We're not here to sway you one way or the other, but other than to say, have your voice heard and get out and take the opportunity to vote. Today, you're going to hear from a few different folks. We try and keep things each year germane to what's happening with respect to not only the content, but who the speakers are. I know for everybody who was here last year, Skip Oppenheimer did just a terrific job, talking about the Fed Reserve and interest rates, which were on everybody's mind. And as we look at this year, Steig Seaward, who is a national director of research for Colliers, will provide a lot of data and information on a national and regional and somewhat local level. And then Andy Scoggins, who's been in Boise for the last 31 or 2 years, has a very interesting look back at Boise, where we were, where we are, and where we're going. And I think it's important, as you're listening to these speakers, and the panel, keep in mind, it's 2024, and for some of us, the pandemic feels like it's 20 years ago. For some, it feels like it was yesterday. But I think what we're seeing and what we talk a lot about at Colliers is the balance we're getting back to. 2020 and 2021 really were outliers, and with as much misfortune and illness and whatnot, I can tell you the commercial real estate industry really benefited, and particularly in Idaho, things just took off. And we've all seen it from the residential housing and all of the development and growth. But those really were not the norm, and you really have to look at pre-pandemic and then post-pandemic now to put things in perspective as to where we are today. You can't ignore the impacts of the pandemic. You'll hear today about remote work and return to office. I believe we're entering into shortly what's known as the return to office war zone. We suffered through the pandemic, and inevitably there was a lot of inflation that followed due to all the supply chain and monetary issues. The pandemic has had a lasting hold, and those consequences of the pandemic, we're still feeling them, but we're starting to move past that. We went through, certainly in 22 and 23, a bit of a downturn, and now things again are more normalizing and balanced. And I know driving in today, as I was listening to the radio, they talked about the latest, third quarter GDP at 2.8% growth. We're still plugging along. We're still growing. The economy's improving. But I think for a lot of us, we're still adjusting to what we lived through in 20 and 21, both good and bad, and trying to figure out where is the normal again. And so I think as you listen to the speakers today, you can have an opportunity to assess a lot of that. I know at Colliers, we're very excited. We continue to grow. In fact, in 9 days, we open up our newest office in Sun Valley with the addition of Mr. McDonald, who I think is here, and these lights are so bright I can't see anybody out there, but we welcome David and what he brings, and we'll be opening up a new office in Sun Valley and continuing our growth across the state. So we're very excited. We see a lot of positive, a lot of continued opportunities. I think the runway is still very long in Idaho and the Treasure Valley and Magic Valley, Portneuf Valley. There's a lot of good things happening. So with that, I'm going to turn it over to Steig Seaward, and I am going to cheat on my notes here just for a second. Steig is the Senior National Director of Research for Colliers, and if you're not totally familiar, Colliers has offices all across the country, the large majority of which are corporate owned. We're one of the few that remains privately owned and local. That means we have the advantage of the network, the platform that Colliers provides, but we're much smaller in scale, and we have our own research team that puts out a lot of this data, but they do it for us. Steig is responsible for a team of 125 folks on his research team, covering 80 markets across the country. So Steig is everything that is data and information in the commercial real estate world. He's been in real estate for over 30 years, and he's been in research, analysis, product design, customer retention, and primarily within commercial real estate and information technology sectors. Steig currently is located in Denver, Colorado, and was gracious enough to fly up and join us and present. So I'm going to turn it over to Steig Seaward. Welcome. You're going to use that?
I got this.
You got yours.
All right, is this thing working? Hopefully. All right, well, thank you. Thank you for having me out here. I'm Steig Seaward, the National Director of Research. Jim asked me to come out and kind of give a high-level overview of what's happening as it relates to the economy. And as I was sitting there, I'm like, Jim, you're stealing all of my thunder here. But we're also going to talk about what's happening with the commercial real estate market, right? And so if we think about, as Jim mentioned, the pandemic has had sort of an indelible impact on commercial real estate as well as our lives and everything that is associated with that. And I think we're going to kind of continue to feel the ramifications of the pandemic going forward for quite a long time, and that's certainly evident within the commercial real estate arena. Oops, go back here. Didn't notice we had that turned on. All right, so let's talk about it. Let's just take a few minutes and just think about what we have been through over the last 4 years, right? So overnight, it seemed like the entire world just shut down, right? Just like that. And millions upon millions of people lost their jobs virtually overnight. While all that was happening, we were starting to just freak out. We didn't know what was going on. I remember I had to go to the grocery store and I'd like hold my breath as I walked by somebody. Things were just crazy, right? And so the federal government jumped in and they just probably overstimulated the economy. Money was just showing up in mailboxes. We were giving businesses, paycheck protection programs and things like that just to try to keep the economy afloat because we didn't know what was happening. The Fed jumped in, they slashed interest rates down to next to nothing. There was just tons of free money that was out there, right? And because of that, The consumers, we were just behaving like a bunch of irrational and drunken sailors. We were hoarding toilet paper. We were out buying boats and RVs and all kinds of things. And we had so much money, and because of the supply chains were so broken at that point, we were chasing all of these limited subsets of goods with way too much money, right? So as a result, prices started to go up. CEOs started to realize they could kind of juice the prices and get more money. Their costs were going up, and then we just kept going up with inflation. So at that point, the Fed then jumps in. They're like, all right, we're going to hit the brakes. They probably hit the brakes a little too late, to be honest with you. And so that's why we had a series of rate increases very fast, very quickly. And then if you remember about a year ago, this is when we really started in the commercial real estate arena thinking, when are these rate cuts going to happen, right? And then we kind of thought they were all going to come maybe at the beginning of the year. And as we all know, it didn't happen until last month. And then we go through this period now where everything's tightening up, and now we're entering this period where things are starting to loosen up again, right? So we've been on this crazy wild ride, and I had a picture of a glass of water there. And some of you might want to argue and say the glass is half full. Others will say it's half empty. I think it all just depends on, if we look at it from the lens of where you are and what your journey has been through this pandemic, is kind of how you would answer that question. So what do I mean by that? Let's talk about housing, right? It's certainly been a big hot button since this is a presidential election year. If we look at the impact for new buyers, right? Those kids coming out of college. I've got 2 kids that came out of college, and so I know all about this firsthand. We can look at what the price of the housing was back in 2019, what I got, $230,000 at an interest rate of, just under 4%. Fast forward a few years, and now the housing costs are, $429,000, and we're looking at, 6-7% interest rate. So the net effect on those young kids coming out of college is that their costs have gone up from $1,100 to about $2,200. So that's really 100% increase. So if you're a kid coming out of college, I can understand how you think this environment is just awful, right? But for the 65% of us in the country that own a home, when I look at this chart, I look at it a little bit differently. Now, I did have kids that are trying to buy houses, so I kind of look at it 2 ways. But most of us should be looking at that, what is going on here? Most of us should be looking at that top number saying, hey, hot dog, my house went up from $230,000 to $450,000. That's fantastic. Can we do this again, right? And so that kind of gets us into this whole thing of, is it half full or half empty? It really just depends on who you are, your socioeconomic background, your generation, all that kind of stuff, to be able to kind of understand what's going on. But it is impacting everybody completely differently. This chart's looking at just the overall impact of what was making up that rise in inflation, right? So you can see that during the height of the pandemic back in June of 2022, when we hit 9.1%, man, we were firing on all cylinders, right? Energy costs were going through the roof, food costs were high, housing costs were high, goods, services, you name it, everything was at a premium. And you can kind of tell by the bar charts there how everything was contributing to that. And now as you look to where we're at, you can see inflation is starting to fall. We're currently at about 2.4% for the CPI. But the 2 components that are really making up the most of that are housing costs and just overall services, right? And so fortunately, looking at this going forward, most economists would agree we continue to see inflation costs going down, because housing costs are no longer ramping up as fast as they were. But unfortunately, it takes a while for the data to kind of trickle in. And so it's going to take a long while before we kind of get back down to that 2%. In addition to housing costs more than doubling, we certainly have had a great time talking about eggs. Who would have ever thought we'd spend so much time talking about just the price of a carton of eggs? Up almost 180%, which is wild if you think about it. But eggs weren't really the only thing that was increasing. As I mentioned, just overall inflation. So if we looked at what inflation actually did, it was about a 23% increase from 2019 to where we are today, right? So that is absolutely substantial. But what you may not know is that wages have finally caught up and have surpassed that, right? So most people now are making more money, and that has accounted and kind of counteracted the rise in inflation, which is good. And then if you really start to take back and look at what's going on in the financial markets, if any of you have 401ks or you play the markets or things like that, this shouldn't come as a surprise. But the S&P is up 90%, right? So when I look at this, we all have different perceptions. Some people are like, wow, the cost of eggs are really expensive. And if you're in a lower socioeconomic class, I can understand how that hurts. If you're in a top tier type of income, you look at this and you're like 90% growth in the S&P. Can we do that again, please, right? So it's completely different depending on where you are in your spectrum. This is looking at the PC price index. The chart on the left just shows if we break out what those core costs were versus discretionary costs. So the core is, just the things you absolutely have to have. And the point of this is that it's impacting different classes differently, right? Discretionary is just the fun stuff. Again, it's the boats and the RVs. And you can see that the core costs were up about 24%. And the discretionary costs were up about 17%. The chart on the right is reflecting how that has impacted the top 20% and the bottom 20%. So what we're seeing is the bottom 20% now has to have more of their limited income going towards those core groups, right? And so they're spending more of their income on that, and they don't have as much to spend on discretionary stuff. Whereas the inverse of that is true for those that are in the top income bracket. There, you can kind of just draw a line there. You can see that we're where we were, above where we were before the pandemic hit, right? So we're spending more money on fun stuff and things like that. For those of you that don't believe inflation is coming down, this is the only chart you need to know. This is the Delta Dental Tooth Fairy Index. You can see the dramatic rise that we have had. It did spike, but it has started to come down, and I feel sorry for any young parents out here. I would have a really hard time paying about $6 a tooth. I think when my kids were losing their teeth, it was like $1, maybe $2 if I was feeling generous that day. But it is coming down, so inflation's definitely moving in the right direction. All right. So we know that the consumer has been driving this economy, right? Initially, we had all kinds of money, and we've just really been driving this. But the other thing that has been driving the economy is the confidence that the consumer has in their own job, right? Nobody has really been concerned over the past couple of years that they were going to lose their jobs. They also had the ability to go quit their job, walk across the street, get a higher paying job, and do it very quickly. And so the labor market has been a big driving force of this sort of recovery that we've had. And this chart's kind of interesting. Everybody's probably aware that we had a big blowout number in September, right? About 250,000 jobs was about twice what everybody was expecting. If we think about where we were a year ago, right? We were all waiting for these rate cuts to begin. If we look at kind of where that is over here, you can see that we had a period where job growth was just really, really strong. And that's why the Fed didn't act when we wanted them to, is because they're like, this economy is humming right along, right? Then we hit April, and the job market just felt like it just completely cratered out, about 125,000 jobs. People are calling for a recession, freaking out, saying, oh my God, the Fed's waited too long. And then they waited even a few more additional months, because if you looked at what happened, job growth kind of went back up and cruising right along. And so now we're at this point where job growth is looking very strong again. And so people are like, maybe the Fed isn't going to make another cut or a couple of cuts by the end of this year. And that's why we've seen sort of this crazy ride of the 10-year, where it was, we had this significant drop, and then it started to kind of go back up again. This is just looking at the overall confidence or the actual unemployment claims that are happening. You can see that, again, just people are not losing their jobs, which is a great sign, another evidence that the economy is very strong. I love this picture for the fact, because I'm pretty darn sure the boss of these two ladies has put them in charge to figure out who they should whack, in terms of layoffs, and they're just having way too much fun coming up with that particular list. Talking about GDP, as Jim mentioned, the third quarter numbers came out today, and it was much higher than expected. I created this chart a couple of weeks ago, and you see I had on there about 2.3% is what we were projecting. Actually came in very high at 2.8%, a little bit lower than the 3% last quarter, but still doing very, very well. We're projecting going forward, it's going to kind of continue at this 2.5% pace, not only for the rest of this year, but for the next couple of years moving forward. So the economy is just moving right along, right? It's still performing very well. And this is why the Fed is kind of taking their cautious approach, and they want to kind of continue to see the data. Speaking of the Fed, in terms of the rates and where we're expecting their cuts and things like that, these are their economic projections based off of from their September meeting where they came out and they did that 50 basis point increase. They're calling for the federal funds rate to now decrease to 4.4%, which means there's two more rate cuts coming, one in November, one in December. But again, these are their projections from September. As we kind of continue to look at some things, as we see if inflation continues to kind of creep up, and if the labor market remains strong, that kind of puts downward pressure on the likelihood that they would have two more rate cuts. I still think that they're going to. We do have a couple of more big numbers coming out this week. Tomorrow, the PCE index is going to be coming out, so we expect to see some attrition on rate there, probably by another 10 basis points. And then on Friday, the labor report comes out, and my guess is that's going to actually look pretty weak based off of the hurricanes that we had and the impact that some of the strikes, the Boeing strikes, have had on that labor market report. So don't even be shocked if that number comes in around 100,000 people. All right. Looking kind of more granular in terms of what's happening in Boise, everything's happening in Boise, right? So this is looking at comparing Boise to 380 plus metro areas across the country. Top line shows the forecast for 2024. Bottom shows the 5-year forecast. You can see based off of the rankings, and again, it's out of 382 metropolitan areas. Boise is kicking it, right? Doing absolutely fantastic and projected to do fantastic through 2028 at least. I probably could have done it through 35, and my guess is the numbers would have been very similar. But single digits for most of those, and housing prices at 76, not too shabby. Looking at how those numbers translate towards sort of the rest of the markets, this is looking at GDP growth and employment growth over the next 5 years. And so where you want to be is you want to be in that top right-hand quadrant. That's representing you have strong GDP growth and strong employment growth. And you can see Boise hanging out way up there on top. There's a couple other markets that are maybe doing a little bit better in terms of overall GDP growth, like San Jose and things like that, but extremely strong in this region. So give yourselves a pat on the back for that. All right, let's shift gears and talk about what's happening in the office market. It has been a heck of a ride, pandemic-induced, right? The problem with the office market is really summarized in what's going on with this chart. This is looking at Castle data. It's card swipe technology, people coming through the turnstiles to get into the elevators. What it's showing is, you can see the top chart, people are starting to return to the office. But if you look at the bottom chart, which zeroes in on the last 2 years, it really hasn't moved that much, right? So that's the problem that we are facing with the office market, is that we have taken a medical crisis, we politicized it, and then we got on two sides of the fence on whether or not you should be going back to the office based off of your political affiliation. This hasn't happened anywhere else in the rest of the country. Everybody else is back to work. We're just not here in the United States. And unfortunately, I think we have drawn this out long enough that we're going to have a hard time ever getting back to 5 days in the office. Looking at just the overall impact of COVID, you can see this is looking at net absorption, so it's a net change in physically occupied space. If we look back what happened in the GFC, you had about 93 million square feet came back to the landlords. We smoked that number in sort of the first 5 quarters of the pandemic. We then thought we were kind of popping out of it, and then the other shoe dropped, and then we were in store for another 111 million square feet or so. If you look really hard at the very end there, third quarter, you can see there's a smidgen of blue, right? That's our green shoots right there. We're pretty excited to see that number, but things are starting to set up for the office market, I feel like, and in a lot of the other disciplines as well. Kind of the worst might be behind us. It's not to say that we might not have a couple of more quarters going forward of negative absorption, but I think we're kind of getting through the tunnel, and we can kind of see the light at the end. No surprise then, as we had all this space coming back, vacancy rates are now at about 17.5%. That'll continue to tick up here for a little while before we start to stabilize. This chart's just looking at overall vacancy rates in 2019, so before everything got real crazy, and you can see the strong markets, San Francisco leading all markets, and there's Manhattan and Seattle and things like that. If we look at where we are today, you can just see the dramatic change that has happened, particularly in San Francisco, right? They went from being the best, tightest market to the worst. The other interesting thing on this slide is you look at Boise. You guys actually went backwards, so you didn't get the memo about the rest of the country not doing so well, and your vacancy rate actually got a little bit tighter. As I mentioned, I think office is set up to start performing a little bit better. Construction is down more than 50% from its peak. Sublease space is also starting to drop, which is very key because that's telling us that tenants are no longer giving back space. They're having confidence in the space that they currently have and are keeping it. That's going to help keep our vacancy rates lower. And this chart's just looking at the overall impact that sublease space has on lease rates. You can see a couple of these markets like Houston and San Jose, they've got more than a 2-for-1 deal on their space because of that, right? So landlords hate seeing these types of numbers, and as the sublease supply drops down, that's gonna help tighten things up. Switching gears to industrial, it's sort of a tale of 2 different halves here. Industrial had this fantastic period for a couple of years there in 21 and 22 when everybody was out spending all kinds of money. That really just drove demand for warehouse space. And so we had fantastic years in terms of overall strength. Vacancy rates dropped down to about 3%. Then we started to build, and just like all real estate cycles, now we have overbuilt. It is now exceeding demand, and so we're starting to see that vacancy rate climb up. We are anticipating we're at about 6.4% right now. We think by summer of next year, we'll hit about 6.7%. And at that point, supply and demand will begin to rebalance. And then the industrial market is going to kind of go on its merry way and become healthy again. Just looking at how the market is done across the regions, you can see that the West and the South have had the largest run-up in vacancy. Those 2 markets were the most active in terms of development, right? And so, we've just oversupplied these markets. You can see some of those cities along the bottom in terms of where their vacancy rates are and in terms of the overall run-up. It is interesting to see that Chicago's vacancy rate has actually gone down year over year. Boise, in this case, it has gone up by about 350 basis points, so you're kind of trending similar to the rest of the country. Looking at overall lease rates, rates are up about 60%. So if you've owned industrial buildings for the past several years, you're feeling pretty good. Well, we're starting to see some rate attrition now in some of these markets, Boise included, about 3% negative growth. The one that probably stands out is the LA region at about 16% negative growth year over year. But don't feel too sorry for those landlords out there. They almost had about 200% growth over the past couple of years. So they're going to get a little bit of a haircut, but I think they're going to be able to weather the storm just fine. This chart's just looking at the amount of free rent that landlords are now willing to give. You could see that it was trending down as vacancies tightened up. And now as vacancies are starting to rise, we're starting to see more and more free rent being offered. We're also starting to, we saw escalations, which had typically been always about 2.5%. As inflation started to rise, we really started to kind of see changes in those actual lease terms with those escalations starting to rise. And it appears that that has peaked out as of about last quarter. And now we're starting to see those numbers starting to come back down again a little bit. All right, shifting over to retail. Retail has been, I love this industry because everybody, like when the pandemic hit, they're like, that's it for retail. I'm like, really? That doesn't make any sense. My wife loves to shop. How could this be the end of retail? People are like, everything's going to shift to online. And that certainly has held true. People are buying stuff online and retailers are trying to figure out their omni-channel approach of making it all work buy it online, pick it up in store, all that kind of stuff. But you can see that retail didn't have its Armageddon during the pandemic because it kind of had this cleansing before we even got into the pandemic, right? A lot of retailers went out of business. We had lots of store closings before the pandemic hit. So they were in a pretty good position heading into the pandemic. And you can see the vacancy rate has just, been about 4.5%. There simply just isn't enough supply in retail right now to whet the appetite of all the stores that are out there. Any retail brokers out here will probably tell you it's just really hard to find good space in the retail sector right now. Talked about the pandemic and its impact. That quick run up during the peak of the pandemic when we couldn't go anywhere and we were just hammering Amazon for something to do. You could see, we literally compressed about 3 years worth of growth into about 2 quarters. We peaked at about 16.5%. Then it leveled off. But the point is, it's starting to kind of ratchet back up, which is good news, not only for the retailers, but it's also good news for the industrial sector as well. In terms of overall space, the trend has been and will probably continue to consolidate, right? They've been trying to do more with less. But the other trend that we're starting to see is that what's not reflected in here is now a lot of these retailers are taking some of their current retail floor space and they're using that for distribution means, right? So their footprint, their shoppable footprint is getting even smaller than probably what is reflected here. This chart's just showing the overall development activity for the 4 major disciplines. You can see, again, retail, basically no development activity whatsoever. Office has had this gradual fall over a long period of time. And then you can see kind of the quick dramatic impact that development, the backing off of it has had in the multifamily and in the industrial arena. Okay, and then lastly, we'll just talk about capital markets. I know I'm pushing my time here. Volume is still not back, right? It's nowhere near where it was a couple of years ago. Interest rates have everything to do with that. Deals just simply aren't penciling out. But now that we've had this we really needed 2 things to happen. One, we needed to know when the Fed was going to stop raising rates, and that happened, a couple of years ago. Then we needed to have that next trigger of when are they going to start cutting rates, and that happened last month, right? So now we know the Fed has now changed their tune and they're going to kind of begin to continue to cut rates. This is going to make it easier and easier for these deals to begin to pencil out and know what your going out strategy is going to be. You can see pricing changes. The pandemic has had a significant impact on all of this, with probably the exception of industrial. But they're all starting to kind of trend back up, which is good spot for commercial real estate. I think the bottom, if you will, is probably behind us. Looking at overall cap rates, this is just looking at cap rates going back to 2005-year chunks, right? So cap rates have increased over the past couple of years. There's no doubt about it, but they still pale in comparison to where we were when we exited the dot-com bust or even during the GFC. Lastly, I'll leave you on this. I think we're in a great spot, right? I think things are really going to start picking up. All the different metrics are really kind of starting to come together for us, whether it's in office or industrial, retail or multifamily. now that interest rates are starting to kind of come back down, and we need them to come back down a little bit more. And the Fed, if you remember the Fed chart, they're projecting probably another 100 basis points next year. We'll have to see if we get that far, but the point is they're coming down. And then this chart's just looking at all of the capital dry powder that's sitting on the sidelines that has been waiting for the moment that we're currently at right now is to go, and everybody's trying to time when we've hit the bottom. So I think we're about there. We might bounce along for a little bit longer, but if you're working with clients, you want to tell them now's the time to get going so you don't miss out on that jump trying to hit that rock bottom price. All right.
Thank you, Steig. Again, just a reminder, if you have questions, we're going to hold them till the end, but you can go ahead and text them in at any time if you have questions following up on Steig's presentation there. Right now, before I introduce our next speaker, we're going to take 30 seconds for a word from a sponsor.
At Washington Trust Bank, can't is a four-letter word.
I think I'll sell my veggies at the market.
Do you even remember to water the house plants? I do this?
You can do this.
Hey, we need to build a home office. We're adding another bathroom.
I think I'll study programming.
Bro, you even connect your phone to Bluetooth.
We believe you can do whatever you set your mind to, and we'll help you get there. Washington Trust Bank, privately owned, locally invested.
All right, well, thank you, Washington Trust. And now I'll take a second here to introduce our next speaker, Andy Scoggin. Andy, as I mentioned earlier, has been in the Boise area for about 30 years. Started off as an attorney in the San Francisco Bay Area. As a two-time recovering attorney myself, I always like to welcome other recovering attorneys that saw the light. And Andy moved here in 1993 to join the Albertson Companies and was with them for a number of years. And then in 2006, he started with a number of other former Albertsons executives, started Albertsons LLC, which was a private equity-backed company focused on supermarket turnarounds. And that company grew to become the second largest privately held company in the US by 2020. Then that same year, they renamed to Albertson Companies and went public on the New York Stock Exchange. At that point, Andy started Scoggin Capital Investment. It's an investment firm with a diversified portfolio, which includes a lot of commercial and residential real estate and other business ventures. And Andy's also a member of several boards, along with his work at SCI, but a lot of nonprofit boards, including St. Luke's Health System, Brighton Development Corporation, Idaho First Bank, and Brundage Mountain Resort. And anybody who, I know we have several Boise Chamber members here. You might have seen Andy speak not so long ago at the Chamber Gala, talking about the impact of the arts on our community and what it does economically. And I really enjoyed listening to him that night, and therefore, Andy's here with us today. So welcome, Andy.
Thank you, Jim. Thank you, Colliers, for putting on this really, I think, meaningful kind of event. Now, 20 years talking about the importance of this sector of our economy and where it's going and what we can do, to take advantage of it, to be a part of it, and to build it. I told Jim that I like coming after a speaker who just gave us some really good news. I'm not an economist. But I learned that economists don't always come to the same conclusions. In fact, somebody told me that if you laid all the economists in the world end to end, you still wouldn't reach a conclusion. But I like the conclusions that Steig reached, which are conclusions that tell us that there's a lot of blue sky ahead of us nationally, but even more importantly here. And you notice that we really are kind of a positive dot still in the midst of more uncertainty and fluctuation in the country. Like you, It's very important to us to know how the market's going to do over the long run. In real estate investing, we follow a few simple principles. They're not earth-shattering. They're just common sense. You've heard them all before, but they work very well for us. So I just wanted to talk about 5 of them. Number 1, we follow the advice of that great investing guru, Mark Twain, who said, buy property. They're not making any more of it. We believe that real estate will continue to be the best long-term asset in terms of value protection, in terms of value creation. Number 2, we rely on the wisdom of another of history's great investors, Warren Buffett, who famously counsels savvy investors to buy when everyone else is selling. Number 3, and this is from Joe Albertson, whose company I was associated with for 3 decades. He built his empire on a certain principle that then was adopted by and very, very vigorously followed by the person who was our CEO and one of my partners in Albertson's LLC, and one of the best and greatest CEOs in retail history, Bob Miller as well. And they believed in the fact that you need to surround yourself with the finest people you can find. 4th principle, irrevocable principle for us that allows us to avoid short-term fluctuations that accompany all real estate investing, and that is avoid excess leverage. Don't buy it if you can't afford it. So those principles: buy real estate for long-term, buy when everyone else is selling, find the best people you can to work with, and there are a lot of them right here in this room, and be very careful with your leverage. And then 5th, which is the subject of my remarks today, is that we are almost wholly responsible for creating our own success, regardless of what's going on in the world around us. I've been fortunate to have had a long history working with and learning from some remarkable mentors, working with some great partners who have been incredibly successful on the investment front. What I found in common in all of them is that they do not trust their success to outside forces, like whether the interest rates are going to be up, whether interest rates are going to be down, what the employment rates are doing, what upcoming trends are going to be. Instead, though they were well informed on all that data, they believe, and I've also built my investing philosophy on the belief that you create your own destiny. You cannot wait for others to do it for you. Investments made now determine success in your future. As we know, Boise is currently, and we could choose a dozen other headlines in the last year, a hot spot on the national stage. Now, some people might say we're just in the right place at the right time. We got lucky, so to speak, but I would hardly disagree. We are where we are in great part because some people decades ago, with foresight, with courage, with persistence, and with understanding, made the investments here in our valley necessary to create what I consider, and the research backs me up, the most important factor in real estate, in the real estate value proposition, which is livability. Cities with a high livability quotient outperform similarly sized and located cities with a low livability quotient. Now, it probably seems self-evident, but the concept of livability can certainly seem elusive to many cities. Fortunately, some really smart people have done some deep study on what separates highly livable cities from other locations, and the list of livability criteria consistently includes these following, and there's others you can add to inform. These are core. Number 1, low crime or safe streets. Cities that have low crime and safe streets are highly livable cities. Cities that pay a lot of attention to and support education. I'll give you an example. When we were trying to bring people, as we were growing rapidly with Albertson's LLC, we were trying to bring people here from big cities on the East Coast, on the West Coast, and the Midwest. And question number 1, what are the schools like? What's the education like? Cities that pay a high attention to and support education are highly livable cities. Cities that have green space that is accessible, that is plentiful, and that's distributed throughout the city rank high in livability scores. Public art, By that, obviously the visual stuff that you see on the streets, but also performing arts, theater and musicals and bands and all of the things that people love to make as part of their social experience. Very important to livable cities. Walkable neighborhoods. And walkable neighborhoods includes walkable not just for residential, but for office. Footpaths, mixed use, traffic controls, things that allow people to enjoy the outside of a city. Smart cities, and this is becoming ever more important, but has been on this list for a long time. Advanced technology in cities, broadband, ability for cities that, or for companies that want to bring their business here to be able to plug in immediately and to be able to adapt to the dramatically changing technology infrastructure that is required to run a great business. Vibrant food and retail environments. So those are several of the key items that are critical to livability in a city. They have been shown to increase real estate value, in some cases by double digits over similarly sized and similarly accessible cities. They decrease vacancy rates, they extend the length of occupancy, and they reduce turnover. Those are all music to our ears, and those are the kind of results we're interested in. Livability, however, does not happen by accident. It's created by design and by long-term thinking, and it's destroyed by neglect and short-term profit. I want to take us back to a big and in some ways close to impossible bet that was made in the past here in our city to understand how we can continue to create our future. So in the late 1950s, Boise undertook an urban planning exercise. They hired a nationally recognized planning consulting firm to assist in building for the future. And one of the items on the list of recommendations that firm brought back was to create a walkable path along the Boise River, a green belt, they called it. Now, what you should know, some of you who've lived here all your lives may know, is that at that time, we're talking about at this point, late 50s and then the early and into the mid 60s, the Boise River is not a pleasant place to recreate. So there was a lot of pollution. There were processing plants that were running their discharge pipes directly into the river. People dumped their abandoned cars into the river. I was told, when I showed somebody a picture of this, that part of the reason that these cars ended up along the river was because before we had Lucky Peak Dam, the city or the river would flood every year. And these were put there to help to maintain the viability of those banks of the river. They did not maintain the aesthetic beauty of the river, though. So the river didn't smell good. It didn't look good. Kids did not swim in the river. No one would, in their wildest dreams back then, have imagined getting in a raft and rafting down that riparian garbage dump back then. But visionaries with intense fortitude and persistence beat the odds, and I think this is really important to know, beat intense opposition to prevail over the next decade and a half with a usable greenbelt. It took a long time, it took a lot of persuasion, it took money, and it took not giving up. But that usable greenbelt has become a defining feature in the Boise landscape, a highlight of the livability of our city. Now, another prime example of investing in the city for the long-term livability, of course, are our beautiful parks, known colloquially as the Ribbon of Jewels. So these parks are built in prime real estate space, but they exemplify a commitment to a greater vision for our community, a community in which people want to live, they want to recreate, they want to work, and they want to raise their families. The Greenbelt and the parks were long-term investments in livability that cost a lot at the time, but have paid off tremendously. Another example from the past is illustrative, and some of you may know about this. In the early 70s, the city faced a bit of an existential moment. Here's a quote from Harper's Weekly at the time. "If things go on as they are, Boise stands an excellent chance of becoming the first American city to have deliberately eradicated itself." Tearing Down Boise was the name of that article in Harper's Weekly. What happens is that city fathers and developers had torn down entire city blocks of Boise in the anticipation of building a massive covered mall right downtown, covering 8 to 10 blocks of downtown. And they started knocking down historic sites, and they got so far as a block away from the Egyptian Theater and what we now have as Old Boise. And those were slated to be knocked down as well when finally that was halted. But now we had a real problem. When the downtown mall didn't come to fruition, many people gave up on the future of our downtown. But a few visionaries and pioneers saw the continued potential, if proper investments were made, to have a vibrant downtown. So you can see on here a whole lot of empty space, and this is actually an early 80s slide. The 70s, mid-70s slides weren't quite as clear for this presentation, but even here you can see that it's not what we see today. One of the companies that made this bet on downtown, really the first one, and one that should have receive incredible credit, is the Oppenheimer companies. They made a huge bet by building one Capitol Center in 1974 in the middle of that rubble. At one time, there's an article I found today that said, or this week, that said it was the only skyscraper in our downtown. And from the front lawn of that building, interestingly, and some of you know this history, encouraged by, allowed by, and actually funded with a personal check for $3,500 by Doug Oppenheimer himself, sprung the beginnings of the Idaho Shakespeare Festival, right? So the first place it was is that beautiful green lawn that's now in front of Kin downtown. And now that has become one of the many prime features of livability and attractability in our city. Of course, having a highly regarded research university with a uniquely colored football field also enhances the criteria of livability in our city. And by that, I mean that funding, supporting, and demanding the highest levels of performance from our K-12 and higher education institutions is critical to the long-term prosperity of our city and of our state. Some more recent examples of investments in livability would include such things as the 8th Street pedestrian restaurant row. Also, Treefort Music Festival, which has certainly helped to put Boise now on the regional and even the national music map. At another significant turning point in our city, downtown city, when people had again grown uncertain about our investment coming into the 2000s, we had, some of you may remember, the hole, the downtown hole. And for those of you who weren't here then, that was a big hole in the ground with some rebar standing in it. And finally, they put a big fence up around it after a few years and let kids draw pictures on the wall, but nobody knew what to do with it. And it left a black eye on our downtown development. And a visionary, in this case, Tommy Ahlquist, backed by Gardner Development, came up with a plan. They executed on it, and it opened the door for another era of exciting downtown development, which we're finding ourselves in to this day. Now, if you want to see another city driving up its livability quotient in real time, and hopefully some of you are from this city, but Caldwell is a poster city from what I've seen. And we, in our company, are now invested in that downtown. They have combined their vision and their effort and their resources, and it's starting to pay off. It's definitely not the Caldwell of 30 years ago. Obviously, these are only a small sampling of dozens or even hundreds of courageous and visionary projects that have been undertaken over the course of our history that have created the vibrant and welcoming environment we have here. But they serve to show that outside sources, as important as they are to be aware of, are far less consequential over the long run than our own efforts. And cities can all too quickly lose their livability if they decide to coast on their laurels. Downtown Portland. Or if they don't pay attention, and if they don't pay attention, then here's another one, city on the West Coast named San Francisco, where I came from. If they don't pay attention, if they don't pay the money and the time and the effort and the courage and the vision to stay relevant, they will lose their attractiveness, and with that, their property values and their desirability as a place to relocate or a place to stay. We are where we are in this town because of powerful decisions made and great projects undertaken many decades ago. As we travel through our town, we see names like Morrison, Simplot, Albertson, and leading companies like Boise Cascade and Micron who've left a lasting legacy of enhanced livability through their significant contributions and investment. Now it's our turn. And the people in this room, you have the intellect, you've got the resources, you've got the vision and the influence to be the architects of our future. So the question I leave you with is, what will our green belt be? Thank you.
Thank you, Andy. Thank you, Andy. We are going to bring our panel of local experts up here in a moment, but first, another word from one of our sponsors at ServPro.
In the game of golf, every detail matters. Precision matters. Power matters.
But if you can't hit it anywhere near the green, nothing matters. Introducing the ServPro Mulligan Ball. Made with ServPro's patented state-of-the-art, like it never even happened technology. The Mulligan Ball was engineered to help you undo it all.
Now anyone can play like a pro.
Come on!
Almost anyone.
Raise your odds of getting it somewhere near the green on your second, third, maybe fourth shot. The Mulligan Ball from ServPro, making any bad shot like it never even happened.
Thank you, ServPro. Want to welcome our panel and with some quick introductions here of who's up on the stage. First from the end, Lance Millington, one of our office agents. Ben Galanos, who is our one of the newest additions to Colliers and our Director of Property Management. When you hear Ben speak, just raise your hand. I can have, if you know sign language, we may need a translator with him. You'll see in a moment, but just let me know and we'll help make you understand what he's saying. Patrick Chetwood, land agent. Tammy Walker, who is one of our owners and in our Twin Falls office, and Don Zeeby, also an owner and in our Pocatello office. So welcome to our panel. And again, I'll just encourage you as we're talking here, if you have questions, please text them. We've already gotten a few. They'll come through to me and I can incorporate them into this. And then also we'll have Steig and Andy come back up at the end and open up for some more questions. But just to get things started, Patrick, I think I'll start with you. You know, I often talk about how land is land and land transaction activity is really a barometer of what's going on. And I know in mid-22, we really started to see things slow down as far as land transactions. We had so much acquisition activity in anticipation of development before that, but it really slowed down somewhere in 22 and well into 23. And just curious what you're seeing today.
Yeah. Ooh, it's on. So when I think of land, I think of dirt and what's happening out there. I think the first thing we think of is residential stuff. So what's happening in the residential world? Last year, very little happened on the commercial side with dirt, but for residential stuff, as we know, we need to build houses. New housing permits really didn't slow down, just the building of them. So what we've seen the last few years is permits being issued are still happening. So what we have in our commercial world, like retail, industrial, they'll follow the residential side by how many permits are going out there because they want to know where the credit cards are being in the Treasure Valley. So as we see the residential trends, we all need a building, we all need housing. We'll probably talk about a little bit more about that. But the main thing with commercial stuff, now commercial is starting to pick up. Downtown stuff isn't quite so busy, so think of downtown apartments and multifamily. We're not seeing so much with the apartments that have garages underneath, retail on the floor, but we are seeing a lot more out-of-state investors wanting to come in and start building apartments. You'll see more in Meridian, Nampa, Caldwell, and so that's starting to pick up again. Now, if we think about picking up, these are investments that are going to be really influencing the Treasure Valley for 26, 27, and they're going to try to get pick up with that stuff, because having a full little over a year now of slowdown with people hammering nails on the ground, it's going to be hard to catch up for what we're seeing.
Yeah, we certainly are continuing to see a housing shortage. As you said, the housing construction activities pick back up, and certainly that'll build out a lot of the land that housing developers have, and as they look at more land, that'll pick up more activity. But it is good to see the residential picking up, and as you mentioned, the commercial activity follows residential. From a development standpoint, we've all, for 18 months, talked about nothing, or 2 years, about nothing but interest rates. And obviously that's, Steig talked about capital markets, the investment markets. That's been a big impediment. What are the other impediments or obstacles that you're seeing, for commercial development right now? Or even, residential development, but.
Yeah, well, a couple of things like Steig talked about a little bit. So costs, right? So the costs of swinging hammers. If you have your local companies that want to grow, they're going to look at existing structures so they don't have to rebuild something. So there's always going to be pressure now with our local businesses. The companies that are building dirt or starting to churn dirt to put up buildings, same kind of thing. That's money that's going to have to be either national or regional because of the expense of doing that. But a lot of those companies, like if you think of the amount of space they're going to use, like if they're not going to build maybe a big dining room for people to sit, if they can put like a coffee shop in, they can have people drive through it. So they're really managing the size of units they're going to build to make it more efficient. So we're really seeing that, but it's all really happening. And again, it's following like where our transit ways are going to be. So you look at Highway 16, who's going to be the first to market there? Where the neighborhood's going to be at? Do we have the infrastructure in place? So then we talk about entitlements. And so I think some of us probably experienced the new planning and zoning rules. That's new. So if someone buys a piece of property, is that going to be zoned for what they need to use it for? And so if they're going to make the investment, they got to make sure that they're going to want to put the building on top of what they want. But our life isn't nearly as easy as I think you guys have in Twin Falls. You have the same problem? Is it pretty easy?
We are. So our lack of inventory there is extremely low too. Our building permits are up by almost 100 over this year as compared to the last 2 years. They were a little bit flat. We are seeing, as far as the development, we do not have enough of the zoning and stuff in place for the subdivision development. So it's causing a lack of inventory in our area as well.
Don, same thing in residential or overall development in eastern part of the state?
Well, in the Portneuf Valley, and that may be a new term to everybody, just so that Pocatello decided it needed an identity. So instead of calling it the Treasure Valley, the Magic Valley, we came up with the Portneuf Valley, which is Pocatello, Chubbuck, Ingham, Malad, that particular area there. So when you hear me talk about the Portneuf Valley, you've got it. But in the Portneuf Valley, our incomes are lower. And traditionally, that requires more affordable housing. So we're struggling in that particular market there to have the affordable housing. And what's affecting that is interest rates and having more competition from a contractor's perspective. We don't have very many contractors in the Portneuf Valley or even the Snake River Valley, which is Idaho Falls, Rexburg, Ammon. And so we struggle in that particular area.
So your costs are actually, you're saying you're higher cost, construction cost or engineering and consulting related costs?
Yeah, so when we try to build a project in eastern Idaho, and I'll just use that frame for now, but we try to get contractors from the Treasure Valley and the Magic Valley, and for them to do that, they've got increased costs, so consequently they pass that on. So we see about a 20% increase in construction costs. That's confidential. in the Portneuf Valley and the Snake River Valley.
So, and I know, Don, you're very involved with Idaho State, but also, curious with BYU Rexburg, BYU Idaho. There seems to be exponential growth going on there in both universities as far as the number of students. Are you seeing retention? Are you seeing job growth as a result? Because obviously one of the things that's paramount for companies is to be able to have an educated workforce.
Well, I hate to say this about Idaho State, but we don't see the retention there. I mean, their claim to fame is their accounting program. Big accountants pull them away. There's probably accountants from ISU sitting in the audience, but in the mental health, So they get pulled out too as well. But in BYU Idaho, they broke all records this year for students. It was like 24,000 students. And if I were a betting man, I'd say within the next 10 years, BYU Idaho's student population is going to be in excess of 35,000. And that's because BYU Provo announced that they were going to do a medical school. Well, if they do a medical school, where are they going to put these other students? And so they're pushing them to Rexburg. So the Rexburg market is growing leaps and bounds. They're getting other companies to come in, and so they're retaining people there. And it's very walkable. It's a great little community.
And it's growing rapidly. I mean, it's certainly one of the fastest growing cities in the state and the region.
Definitely is multifamily there with all those young families going to BYU Idaho. There's a tremendous need, a tremendous amount of permits being done there in Rexburg.
All right, well, shifting gears a little bit here, Lance, I want to pull you in, and we've talked about, we teased a little bit about the pandemic and the effects on the office market, and we all know what happened in 2020, but where do you see things today? What's the status of the office market?
It's a really interesting subject. It seems like use of office space and what's happening in the office world has become almost like a universal business conversation that everybody knows something about. Are people going to the office? Are they not going to the office? There's a lot of discussion about that. Steig shared some really good sort of U.S. national level information about what's going on in office. We saw that about an 18% vacancy rate nationally. We're at about 8% here in the Treasure Valley. Actually, here in Ada County, about just under 8%. Canyon County, by the way, at 2.5%, so fairly low. But there's a lot more beneath that our research team has worked out for us. About 90% of all of the vacant space in Ada County is in office spaces that are greater than 15,000 square feet. So when you think about that, that's just 10% of all that space that's available in smaller office space. So what that means is if you're looking for somewhere 2,000 square feet or 8,000 square feet, there are not that many choices in the valley. There's just not that much open space out there in that smaller space. I think another interesting slide that Steig put up there was the sublease market. And we've always sort of thought about this as a problem maybe in San Francisco, where they have 25 or 30% overall vacancy, and a huge percentage of that is sublease space. But that's happening here with us to some degree as well. About 22% of all of the office space on market in Ada County is sublease space. And that's, I think, just an interesting thing that points to maybe some other trends that are starting to affect us a little bit here as well, even though we still have really low and enviable, I think, office vacancy. So that's kind of what's happening right now.
Are you seeing any trends as far as downtown versus suburban office demands or needs, or
I think that's a really good
some of the
point.
vacancies you're talking about?
Yeah, I think that's a really good point. Those of us who spend our time driving east and west around here notice that there's a lot of shift in terms of office space out there. Office space vacancy in the downtown core, where we're sitting today, has been trending upward slightly. Not huge, alarmist kind of a number, but it's trending upward, about 12% vacancy in downtown, and that's moved up about 3 to 4% over the last couple of years. So I think there's a bit of a migration that direction, westward.
Now, I did notice on Steig's slide, regarding office and national trends, and one of the things was the little smidgen that he pointed out. In Q3 of this year, we actually have positive absorption rates for office. Now, I'm also at the same time reading articles about Dell and Amazon and other companies requiring a return to office.
Yeah.
Is that related, or are there other factors that you see that are impacting that creating that posipositive absorption?
I think it's a great question. Is it supply or is it demand? When it comes to that number, that absorption number, you also saw on Steig's slides that for the last 5 years, the number of new office starts has been trending downward pretty rapidly. That is a down and to the right and down trend line. So there's not as much office space being built because everybody's looked around and said, well, we've got a lot of vacancy, let's not build as much office. So that little blip out there says a couple of things. I think more space is being used, and there's not as much being built. You mentioned Amazon and Dell, and I think that there's a lot of other companies that are maybe not that big and visible that are also saying, hey, it's time to get back to the office. We're going from an invitation to a mandate. And for the Amazon group, it was, this is where our work is. It's in the office 5 days a week. And if you don't like that, you might want to look for work somewhere else. That's public statements that they made. And I read a really funny article that was connected to that said that there are people that work at Amazon that are rage applying in other places. Like, I'm so mad that I have to go to the office that I'm going to go apply for work somewhere else where I don't have to go to the office. I thought that was kind of interesting. We'll see who has the leverage over time. I think that Amazon, when they make a decision like that, they kind of know who has the leverage. And I think that trend of more of those big companies requiring their employees to be back in the office is a good indicator and maybe a signal of what's happening and what will continue to happen.
We're also seeing some of that, Jim, locally within our management portfolio, where we've seen a number of our bigger tenants mandating to come back at least 3 days, 3 and 4 days back in the office, 1 and 2 days remotely. So, it's interesting. We saw a study that was done, I think it was in September this year, where it was done by KPMG, and they said that they interviewed 83% of CEOs that they interviewed said that they saw 5-day mandate back in the office happening in the next 3 years. So we're certainly seeing that from a number of our bigger tenants. I mean, I'm speaking for our portfolio here, but we're certainly seeing it. And there's been resistance to some. There's been others that have enjoyed it, but I think there's been a little more resistance than people thought, which is interesting.
That's interesting, 83%. I hope there's some Colliers employees in the audience listening. They may know what percentage I'm in, whether it's the 83 or 17. But Ben, piggybacking on that, what, with this return to office and the need to be back in the office, and let's face it, if you've been working from home, there's certain comforts and things that you don't get in the office. What are you seeing landlords doing now to attract people back, to get people to want to be back in the office?
I mean, it's a good question, because it begins both. I mean, if you look at new leases, just briefly, the things like the TI allowance, the tenant installation, how are their fit outs that they're building in their offices? What does that look like? And we've seen landlords, and Lance and some of the others can probably speak to this, but we've seen landlords with a vanilla shell, which is, has the flooring and what have you, doing $30 a square foot as an incentive, and then with a grey shell, where it's just a concrete shell, up to $75 per square foot as a TI allowance, a tenant installation allowance. But even with that, I think one of the key things has been that they bringing people back to work. We've had tenants where they've redone the whole office, they've repainted it, they've put in new furniture. They want it to be a little nicer. And then on top of that, because they've got these hybrid situations, what they're doing is they're putting in more collaborative space, more spaces where people can come. We've got one tenant who put in booths. It's like Happy Days, if you remember that old show, and where they can come in and they sit down, and they've got the kitchen and the cafe, and they're looking for things that are amenities. And I've seen people including free gym memberships. The other thing, a big thing, is parking, and tell me if my accent gets in the way here.
Parking. What he's talking.
Parking at the parking lot. The big thing is that people want to be able to park for free, and so, or at least have convenient parking. So they're sort of working that into their contracts where they're doing that. But what we're seeing is we're also seeing a wait list. Now let me say that, a wait list. Some of the bigger operators downtown are saying that they're back, all their facilities are full. The majority of them are, and so people are waiting to get back in to get parking spaces. So these are, we're seeing people having to really, tenants and landlords are thinking, how do we make this, we want to protect our asset, we want to protect our people. So it's a really interesting situation.
And all of those come at a cost, though. Those are a lot of what you're talking about. Well, some of it's in the office, but then some is common area. What are you seeing from a cost standpoint, as far as, that's you pay your base rent, and then you have common area, and you have maintenance costs. And I'd be curious if any of the agents, what you're seeing, what tenants are focusing on. But how's that being handled, Ben?
Well, the CAMs, as we call them, I'm sure everybody knows, are the common area maintenance costs. You know, and the interesting thing is that I'll give a plug for Colliers, even though we're not here to do that, but we've actually seen in our portfolio, CAM costs have actually gone down over the last 18 months because, again, I was thinking about this, call it PTSD. People, you know, from the pandemic, employers particularly don't want to lose their staff. You know, we saw staff shortages. We saw all of these different things, and employers and tenants are acutely aware of that, and they're more sophisticated than ever before. And so you're dealing with them who've got access to more information, and what they're looking at is, how do we reduce costs? And they want to be able to see that. And so they look to their property managers and their landlords to put pressure on their property managers to reduce costs. And so, like I said, there's this PTSD. But ways that we've been able to do that is little things. And again, it all adds up. So things like landscaping, where we've got, instead of annuals, we put in periannuals, so plants that last more than 1 year. Things like security, we've had tenants and landlords where they're putting, rather than having someone patrolling through in a car 5 times a night, we put in these active security cameras that have a microphone, a thing, and someone in a monitoring station, that someone walks on the site, a light comes on, you're not meant to be on the property here, please vacate. And if they don't, then they call the security then. Just little things like this, working with Idaho Power to do assessments and upgrading lighting to LED, which reduces electrical costs, and there's rebates that were given back for that. So because of this, as I said, we've actually seen CAM rates go down over the last 18 months, which has been surprising but welcomed by a lot of tenants. But the tenants are expecting that, so it's interesting.
Don, Tammy, Lance, I'm curious, you all do a lot of leasing work. Is this something that's a real focus for tenants? Because obviously, just past the pandemic, during and post-pandemic, we saw Steig Seaward, all the inflation and the cost going up. I would assume that there's a
it's very
higher level of scrutiny.
Yeah, tenants are really tied into this. Like Ben said, they're really sophisticated in terms of understanding what their base rent is, and then what are their additional costs going to be. And a lot of them went through some, significant, maybe not sticker shock, but shock when they saw what was happening with costs like landscaping, because there were fewer people available to actually go out and do the work. They ended up paying a lot more. Landscaping became more expensive. As an example, janitorial, fixing an HVAC system, just getting parts for those became really expensive. So all those costs are passed through to tenants as a part of this CAM cost. And so tenants, they saw significant increases in what they were paying for rent. Now it's been flatter for the last year or so, but they really dial into that. So when they're looking at the front end of a lease, they're trying to figure out, what is this looking like? What is the history of these CAM charges? They really want to understand what they're going to be paying for rent. And that's a little bit of a change of what it was maybe 5 years ago, when there wasn't maybe as much attention on that, and they're really dialed in now. So it's very interesting to see.
One other thing, if I can add, Jim, is that what we're finding also is that tenants want a collaborative approach. I mean, it sounds very new age, we want to be collaborative and whatever else, but in all honesty, we don't want to be doing stuff that isn't working. And the best way to do that is to talk to the tenants. Is this working? Do you need this much, this much adjustment on your HVAC? Is it too cold? Is it too hot? Well, we don't go in that room very often, and with all the different zones, we can hone it a lot really quickly, and depending on the buildings. So, that collaborative approach is proving really successful, which is great.
Thank you. Don, bringing it back to you for a minute. We've had in the last several years, there's always been a lot of talk about, particularly in the Treasure Valley, but across Idaho, the industrial growth and industrial space. There's been a lot of new development. Are we absorbing that space? What's the activity look like in the various markets in Idaho right now?
Well, I would venture to say that the preponderance of business being done is happening in the Treasure Valley, bar none. If you look at the total inventory across the state, when I mean the Treasure Valley, the Magic Valley, the Portland Valley, and the Snake River Valley, when you look at that total inventory, the Treasure Valley's got 55% of all that inventory. So, and between all of those, there's about 1 million square feet in absorption. So when you look at the Treasure Valley, the Portland Valley, the Magic Valley, and the Snake River Valley, what we're beginning to see is this 1 million square feet is being absorbed rather quickly. Now, in the Portland Valley and the Treasure Valley, we've got about a 3.5% vacancy rate. but they're only building 56,000 square feet under construction right now. And that's because in that part of the state, they're not building unless there's a lease signed or a commitment. In the Magic Valley, they're at about 1.8% vacancy. Phenomenal. But they've got currently under construction now or planned to be 1 million square feet. And that's all due to the agricultural industry. And maybe, Tammy, you can kind of tell us what's happening from the agricultural perspective over there.
In the Magic Valley, running from Burley to Wendell, basically, we have a collective group there that is very instrumental in our economy in our area. And so in the last year, we've opened up 3 new factories in that area. It's a Southern Idaho Economic Development Organization, and they partner with, obviously, our governor, but all the chambers around the area in these small towns. It's a very collective group and very progressive, and they have been very instrumental in bringing in the manufacturing and opening and continuing to open with even more resources, more people from France now coming in that are all active in the food industry in some level. And so, hence, speaking to that 1 million square feet, that's kind of where our warehouse industrial market is turning right now. We're having to build to actually take care of that distribution process. So it's a little bit of a shift in the market. We still are, as Don said, very low on inventory, but it's a strong.
Well, I've seen, sorry to interrupt, but I've seen, Tammy, when Chobani was there, Chobani ended up doing business with a company that was, from a supply chain perspective, makes all the Chobani cups in Burley, and then lids and the cartons, and then they ship them to Chobani over in Twin, and they fill them up with the yogurt we all eat, and then it goes out, sits in a warehouse, and it's distributed across the United States. So from a supply chain perspective, it really is becoming an important aspect in the agricultural business. Sliding over to the Treasure Valley, and don't get alarmed, but you're sitting at about an 8% vacancy rate. And that's okay, because the trend right now is that we're beginning to see more of a supply and demand balancing act happen in the Treasure Valley more so. And there's an additional 3.4 million square feet being built here that's under construction now over in the Caldwell area. So when you look at what they did at the airport, what's happening in Caldwell, the construction that's going on now, what's happening around the Idaho Center, and not to mention what's happening at Micron, and you know, you might, Lance, want to mention the supply chain and all of that that's happening at the Micron.
I think there's an interesting story that's unfolding over there, not only in the industrial that we've seen really for the last almost 2 years, a lot of activity that supports the Micron construction side of things. But what we're starting to see now is a lot of the Micron suppliers, these companies that do a lot of business with Micron, that are really integral to Micron's production capability, are looking at this and saying, okay, we are going to have to double the size of our office. We're going to have to double the number of people that we have here. We need to attract and retain really good competitive talent into our space. So there's a lot of these suppliers that are looking to double or even triple the size of their business here as they prep up to be good supplier partners to Micron for the next 20 or 30 or 50 years, whatever it might be. So we're seeing good activity. Several of those companies are really looking at office space and getting ready to expand what they're doing over there. So not only is it an industrial draw, there are other things happening. And I think the retail is kind of following it that direction too with some of the things that we're seeing. So.
Appreciate it, Lance. Yeah, I think when Micron was announced a few years ago, I think the initial reaction was going to be all these jobs and all this office space. That's going to be the answer to some of the office issues. And what really happened, it's a delayed effect, because the leasing activity that's happened to date has been primarily for companies in construction and the development of the Micron campus. Now you're saying that the long-term vendors are seeing their contracts become more clear, and they're going to be adding. So that, Patrick, that begs a question. You know, that's the old, if you build it, they will come, right? If we build this big campus, there's going to be all these people, 20,000 plus jobs. My question is, if they build it, where are they going to live?
I know. Yeah, so if we think about that, if we look at housing permits in the Treasure Valley, and I think we hover around 4,000 permits being issued per year. And if we talk about 20,000 jobs, the math is at 20,000 jobs with those increasing, that's one house. So you want to think that's 1.5 house per job. So that's 30,000 houses needed, projected in the Treasure Valley that would need to do something like that. It's kind of crazy, huh? Like, I mean, I just wrap my head around where we're going to put. So if you're on that side of town, and we have Southeast Boise, there's the Lake Hazel connection that's going to run across the valley, hopefully sooner than later, because we don't want to be reacting too much. When we talk about, and he was talking about our moment of how do we plan for this stuff. Well, now's the moment because it's coming. And so we really, the main things are we got to have sewage, we have to have schools. I mean, the thing is we can't blame our municipalities for not approving construction projects if we can't pay for the schools that have to have the neighborhoods being built around them to get the sewage ready and get the power. So those things have to happen. And so everybody in this room, we're kind of burdened with that. It's like, figure out a way to do it. We have a lot of work ahead of us if we're going to try to figure out how this is all going to happen in the Treasure Valley. It's freaking scary. And I'm quoting Ben, so it sounds cool with an Australian accent. but it's something that's really serious and it's exciting. I mean, we get excited about it, but that's our little battle we get to go up against here.
All right, Tammy, I want to, with a couple minutes remaining here, just shift to, for a moment, the retail sector. And I know Steig pointed it out, and he talked about the pandemic, and everybody thought retail was going to end. And I remember longer ago when the internet came out, and everybody said, well, the retail's done. I mean, retail has died and resurrected many times, and it seems to repurpose. But what are you seeing right now? From number one, what are the impediments or the issues for retail from a leasing standpoint? And two, what's driving the leasing activity in retail? What are the areas of industry that you see that are most involved in retail?
Steig was saying that a lot of the retailers have reduced their footprint. So they're repurposing 80,000 square foot buildings into something a lot smaller. Inventory, as you were saying, Lance was saying, inventory for the product, it just isn't there. We are seeing a lot more of the national tenants coming back in with the drive-throughs, the QSR. Product is obviously because of COVID, that's a really big demand right now, anything with a drive-through on it. But it's really lack of inventory and developing.
Seeing the same thing, Don?
Well, I definitely in the QSR space, even in the multi-tenant building, I see developers being more creative, creating double drive-throughs. So they have got 2 drive-through windows where it used to be just one. I'm struggling to find space in the 15 to 16,000 square foot arena across the state. Just can't find it. It's just not available. And it is construction. What's making it struggle is people in the Portland Valley and the Snake River Valley can't afford to pay from a lease rate of $38 per square foot, and then have the CAM charges on top of that. So they end up paying $45 a square foot. Because the population isn't there. When you got a large population like a Salt Lake or a Boise, you can absorb that, but we can't absorb that in that particular area. So we're not seeing the growth that's happening in this particular side of the state.
All right, well, with that, we're going to wrap up our panel discussion. I'm going to ask Steig and Andy to come on back up to the stage. While we do have also our final word from a sponsor, Land Pro Data, as they come up, and then we will address some questions that we've gotten from the audience, and if there's time, we can open up for some more questions.
Why Land Pro Data? Land development professionals such as surveyors, engineers, planners, contractors, developers, attorneys, appraisers, title companies, and realtors need easy access to data starting with parcel information, subdivision plats, surveys. Knowing when an event occurs at City Council meetings is also useful. Land Pro Data collects the information and provides it in an easy-to-search and view format, so you can get what you need and do your work with confidence. And Land Pro Data can be wherever you are, in the office or standing in a field.
All right, thank you, Land Pro Data. We've got a few questions here that I think I know who they go to, but I'll do my best here. Don, we hear a lot about AI, artificial intelligence, and you're just talking about retail, and this question popped up. Are you seeing anything in the industry, from an artificial intelligence standpoint that is impactful or beneficial? Is that becoming part of the commercial real estate?
Oh, awesome question. Whoever asked that question, that is just a spot on question. Yeah, we're using a lot of artificial intelligence right now in being able to see the tendencies of traffic patterns by people, where they go, where they eat. If you're using one of these, you're being tracked. If you turn them off, you might still be being tracked. And so they know where you're going. And so that information is available, not you specifically. They don't share that kind of data, but there's data out there that allows us to see traffic patterns and where people are shopping, and how often they're going to a particular grocer. As an example, I did one for Winco in Pocatello the other day. Found out that they have over 1.8 million people showing up to a Winco a year. And I compared it to the Costco in Pocatello, and you'll be amazed that the number is identical, 1.8 million people. But what was happening, the adjoining tenants were creating a much greater traffic assemblage of people going to a specific area, that I shared that with a couple of retailers we were trying to attract in the area. They went, wow, we definitely want to go there. We don't want to go there. And then from an industrial perspective, we can see traffic patterns from vehicles, where they're going. They too traffic intensive. Is the road's going to be 3 or 4 or 5 lanes to make it available? So the information is phenomenal.
Thank you. Ben, so with the post-pandemic, there's a lot of talk about empty office space, and there was a lot of discussion that particularly in some of the larger cities, maybe not necessarily Boise yet, but repurposing of office space. And I know that we've talked about a shortage in housing. Are you seeing spaces being repurposed, office in particular being converted to residential?
The short answer is no. I mean, there's been a couple of different examples of things being repurposed, and certainly in other areas you've got things like industrial, where you've seen churches go in and use an industrial thing, or retail, where you end up with a fitness, like a gym, MMA type studio or something like that, going into a shopping center type area. But it really comes down to highest best use is the little jargon term, and the amount of money that it will cost to convert these office spaces into residential, and then what are you going to get for them at the end of it? And at the moment here in the Valley, it seems like it doesn't make sense yet. Maybe if we build up in 20 or 30 years and we've got real density, you've seen along Chinden, you've seen as you go towards the downtown, you see breweries, you see different axe throwing and all of this sort of amenity, sort of entertainment stuff popping up, and it's kind of a cool little precinct, it's turning into that. But this wholesale or larger migration from office to resident, it just hasn't manifested itself yet. So,
Lance?
I was wondering if I could just add something, and Steig probably has a really great national view, but one of the things that we've seen a few times is somebody who might have call it a single level office that's been vacant for a while. It might be 50 years old, having trouble attracting a tenant to, and we've seen a couple of people convert that to flex space, where maybe a portion they take out the ceiling and go up to the hard lid and put in an overhead door and make it accessible to a truck. And that conversion, because flex space is a really attractive thing right now. People need that flex space, contractors, different uses for that. So we've seen that happen a couple of times for older office space that, again, may not be in the best spot, may take a ton of work to get it converted into newer, modern-looking office. They're converting it to something like a flex space, and that's been really successful for some people that we've seen.
Steig, I'd be curious from a national view, because I think the question is really focusing on large office buildings in San Fran or Manhattan or wherever it might be becoming apartment buildings.
Yeah, so we're just starting a study on conversions that are happening out there, and our preliminary numbers are showing there's about 240 projects across the country that are actually moving forward. It's not like, oh, this building could potentially be happening. These are projects that are actually moving forward and going into a variety of different uses from office. I mean, the one that makes sense that everybody's like, let's do that, is to convert it from office to multifamily, right? But if you look at the economics of it and you look at how the majority of these larger office buildings are constructed, nobody wants to live in an apartment building that has no windows and things like that. So most of the buildings that we're finding from an office standpoint, the number's probably about 10 or 12% would even be viable to convert for that. But we are seeing other uses that are coming out of it. One that comes to mind is you look at the Allstate campus in Northbrook, Illinois. They essentially just tore that whole thing down, and now they're building up high-cube distribution buildings, right? And so we're starting to see a lot of this. It's not to say that office to multifamily can't work. We've got a project that we're trying to kick around in Denver, and there's a couple in Atlanta that are already taken off. Not to have apartment buildings where you each have your own individual kitchen and things like that, but the idea is to go more dormitory style, where you have your own bedroom and your own kind of living area, but then you're sharing a community kitchen and rec centers and all that kind of stuff. And that sort of footprint works a lot better in some of these larger buildings that have the larger footprints with the column spacings and things like that.
Thank you. And I'm going to step out of order here for a minute, something I neglected early on. I do want to thank and recognize any elected or governmental, city, municipality officials that may be here today. You'll see why I'm doing this in a moment. But are any of those officials that are here? I know I saw Mayor Simonson and Stephen Jenkins, any others? Bobby Joe's the head of the Chamber of Commerce. Bill Connors, who's former head of the Chamber of Commerce, but still in charge with me whenever I see him. Anybody else? That Tom Keeley is here. Well, I want to, Stephen Jenkins in particular, I know Caldwell and head of development there, heard a lot of nice things about him. And so I wanted to thank them before this next question, which is to the local experts, how difficult are the city officials being to get anything done? How are you finding it with rising construction costs? How difficult is it to get something approved? Be careful.
Oh, I cleared my throat at the wrong time. That was totally I think that, I grew up here and my family moved to Meridian in 1979, right off Eagle Road, Eagle and Franklin, and it's changed quite a bit. And I remember my mom when I'm totally going to rabbit hole now, but she was frustrated when we moved from Missoula, Montana, when I was born. But she couldn't believe there was one high school that was overcrowded and there was 2 shifts going on. And trying to get money raised and to build new schools. And that's challenge is the same thing we still have now. So if we want to talk about population issues, well, we have to have schools to approve the permitting process to get everything moving, and then you have the sewage and the power and all that momentum. So, I think I feel that this is the same discussion we've had for a long time in the Treasure Valley. And so I'm not saying, so yes, there has to be consistency in our elected officials for what we can and can't do, how that's clearly communicated. But it's all all of our responsibility to create momentum and drive the changes that we want to see. And we can't just keep fighting growth. It's happening. I mean, so there's no reason to fight or say we don't want more people here. We want to have our ski run to ourselves. We want to have our Boise River to ourselves. That time has passed. So now how do we make it efficient so we can all make it the place that we all want to live and keep it that way? And that takes effort, drive, all things that you have. I don't know about me, but you're the man. But these are all, he made some really good points, and that was really inspiring of what Andy was saying, but that's my response.
Can I give a quick anecdote? Because I think that the question is good, and this one, I don't think you apply to people that are trying to build large developments or do all of that. But we had this just a small example of how Boise City, from where I started working with them 20 years ago to now, seems to be willing to kind of listen down the planning department. So we have an older apartment building, 30 some odd apartments, and built in the 30s, and we had an apartment fire this spring that completely gutted an apartment. Luckily, nobody's hurt. But got our insurance, got the contractor, and they started down the project just to fix it up. And they got to the plumbing inspection, electrical pass, plumbing, and the plumbing inspection says, well, sorry, you're gonna have to pull a whole permit for this thing. Well, we just thought we were gonna, clean up this apartment. Nope. So go down to the planning department, and they said, the guy that was down there said, well, we're gonna need the original plans for this 1932 building. Or who knows where they are? Well, that's what we're requiring. And my contractor's pulling his hair out, and I just made one phone call to somebody who was in the department, very good at listening, understanding, said, oh, all right, did not understand that. Tell you what, tomorrow I'm gonna go down with our lead inspector, we'll just walk it. And within 2 days, all of this stuff that was understandably required under certain circumstances, given the fact that it didn't work, we were, all right, let's get this project going. Let's get one more apartment back into circulation for a town that desperately needs, lower cost apartments. So I really appreciated that, though the rules are important, we're willing to get up out of our desks, away from our desks, go down, take a look at this and get it going within a week or two, instead of, months of back and forth red tape. So it was good experience.
Anybody else? All right, I guess I would mention just quickly, I think it's a great question, and in out of respect to all of the city and state officials that may be here, that was probably asked by one of our competitors. I apologize, they may have texted that in, but I've said this often though, I lived in Denver and saw tremendous growth in Denver. Then I moved to Salt Lake, and then I've moved here. And people always ask me about the comparison. I say, well, Boise's just about 15 years behind Salt Lake, and Salt Lake was about 15 years behind Denver on that growth scale. But what I saw and have seen in all three is when you have tremendous growth, there's always going to be complaints. There's always going to be concerns and issues with entitlements and with approvals. And one of the other questions here is, hey, this growth is great, but where's the water going to come from? Where's the power going to come? That's what the city officials are grappling with, and that's what they have to deal with, is not only try and respond to the demands for new development, new houses, new schools, whatever it might be, but also how do you supply those? How do you power them? So it's a real balancing act, and we see it obviously in our roles as brokers. We have clients who are applying for approvals, and there's frustrations, and there's some that aren't as frustrating. But I do think it's the collaboration and getting folks to get out and take a look and talk and see what might be the real issue. I know that with some of the very big projects that have been coming in, for example, Idaho Power has been fantastic. They try and get out ahead of things, and as we're trying to attract bigger companies to come into the Treasure Valley or into the greater Idaho, Idaho Power has been very good at being proactive and trying to find answers, because the water supply is not infinite. And we've been lucky with very low power rates here. It's been a very attractive element, for development for years. But that's going to change, because we don't have unlimited sources or resources. So, and that leads me to the last question as we wrap up here, and this is for the overall anybody. And I'd be curious on each of your inputs, but the question is, Andy talked about our Greenbelt moment, that, we had a moment back when they decided to put in the Greenbelt, and that was kind of groundbreaking and helped Boise launch forward. As we sit here today, what's our next Greenbelt moment? The question is, what do we need for the Greenbelt moment? It's open to anybody.
Light rail.
Light rail.
I'll second that one, Jim. As a foreigner, although I have a green card, my citizenship's coming next year. I think, I've lived in Melbourne in Australia. I've lived in Sydney. These are both big cities. They were smaller when I lived there, but Melbourne did it right, and I say that because I'm from where they planned. They were active rather than reactive. Sydney didn't. They were reactive. And the two cities are worlds apart, and it took Sydney a long time to catch up. But, you know, we've really got a plan. And if I had to say it as an outsider, and please don't throw tomatoes at me, or tomatoes.
Tomato.
Is light rail, because not only does it move people around, but it will afford natural precincts or areas of development. And these are the little stations. You end up with little villages, little places at the stations, and it's very it can be done really well. It doesn't have to be overwhelming, and it works really well. But yeah.
Jim, when I watched Andy's presentation, I don't know what the Greenbelt moment is. I think this is a fabulous idea, connecting this valley way better than it is today. But one of the things that jumped out at me when Andy was presenting was there were people that were opposed to this amazing idea that we all benefit from, that really has been a part of transforming this place we are. So I'm looking at that and saying, okay, when the next Greenbelt moment is coming up, I hope that all of us who have some influence are thinking long-term. So it's not necessarily the Greenbelt moment, but maybe we ought to be looking at ideas like that and saying, what does this look like for our children and our children's children and way down the road 100 years from now? I think that's going to be an important part of what we do next.
Absolutely. I think, you know, and I mentioned Denver and then Salt Lake. I was there in both of those cities when the light rail was constructed, and there was a lot of opposition, and those both operate well beyond capacity now. You know, everybody, when it was being voted, they said, well, no one will use it. And we talk about like the front runner in Salt Lake that takes you all the way from Ogden to Provo and with stops along at Salt Lake. It's you know, overcrowded. It's being used so much. So I don't know if it's light rail. I would say that, you know, and based on some of the questions, it's infrastructure. We are growing, and we have to think ahead, and we have to look at those things that will drive us 30 years from now, not just today. So.
And I've got a list as long as my arm, so we don't have time for it, of things that I think would be phenomenal, and, you know, you can't do everything at once. Light rail is definitely right at the top of that. But I think to connect that is you get downtown on light rail, you've got to get around. And I think if we had a better public circulation system than gigantic buses with 3 people in them, that, you know, people aren't necessarily feeling as comfortable. And I think this might work. You know, what really is full all the time are those little bars with the pedal things. If we did like 100 of those and put them downtown, we'd have a great circulation system. But I think a circulation system that makes sense and works, I think a real performing arts center downtown will bring the next level of vibrancy, keep our hotels, our restaurants, our other spaces even more active. And I'm talking about something where real, you know, the plays and the things, the Morris Center is awesome, but something that, you know, goes downtown and that has the state-of-the-art requirements for that. I think we got to have a plan for low-income, homeless, and other, you know, people that's really thinking forward and doing it in the right way, and we've seen it done in the wrong way. And I think this city's done some things that are right, but it's coming. That wave that other major metropolitan areas have, we need to have that on our list. So there's lots of things we can pick off of, you know, and continue to be the place that we want to live and we want our kids and grandkids to live.
All right, well, we are just about wrapped up on our time, so I want to thank our panel and round of applause for the group that's up here, and everybody come down. And with that, this is always my favorite part because I'm the last thing standing between you and alcohol. We do have a reception in just a couple moments here with hors d'oeuvres and drinks and an opportunity to speak with any of the panelists or speakers or any of the Colliers agents that are here. Please reach out if you've got further questions. Again, I'd like to thank our sponsors, our presenting sponsors, Givens Pursley, Washington Trust Bank, Land Pro Data, and ServPro. Thank you so much. Our co-sponsors, A10 Capital, Bus Mechanical, Rocky Mountain Electric, TradeStar Construction, Cutting Edge Landscape, Centermark Roofing, and Biome. And the last thing I would say is we look forward to seeing you next year on October 14th, 2025 for the 22nd Annual Colliers Outlook. Thank you all for coming.